The focus on tonight's budget is what might be in it for you, the voter. That's fair enough. There's also a bigger picture, though, on debt in particular. Where is our debt headed? Is that worth it for the health of the economy? To help get our heads around what we're in for tonight, let's bring in Chris Richardson, a partner with Deloitte Access Economics. Thanks very much for your time. In terms of what will be added to debt, everything we're hearing tonight, it seems to be one-off payments, i.e. not baking them in to spending. So add a few billion onto the debt, but not year after year. Does that seem to be the strategy to you from the government?
Absolutely. And to be clear, we're not talking about good policy here. It's all about the politics with an election just around the corner. And the one thing I would hope, since it's not going to be good policy, is that it isn't permanent policy. Your words are exactly the ones to focus on. Is it baked in, or to what extent is it baked in? We all know that it's going to be more expensive in the next little while, but is that this financial year or next and nothing thereafter? That's my limited hope at this stage for tonight.
Interested in your thoughts in terms of this fuel excise cut, whatever's going to happen. So there's two ways to approach this. Give people money, then presumably they can spend it on anything, and that should add to inflation. If you cut the price of petrol, though, is that something that doesn't contribute too badly to inflation? Yes, you're reducing the price of petrol, but people aren't really going to buy more of it, you wouldn't think. Is that a better way, if you're worried about inflation, to tackle this particular issue?
Not really, because why are you worried about inflation? In part because it's the potential reaction out of the Reserve Bank. And the Reserve Bank will be watching this budget very, very closely. I don't think that they are as near to raising rates as many market economists would be. So, a bunch of the banks see the first interest rate rise in June. We certainly don't. We would see it at the end of the year at best. But the Reserve Bank will be watching this one pretty closely. It doesn't matter that a cut to the fuel excise would artificially lower prices for a time. The Reserve would be focused on that underlying pressure. Extra money spent atop an economy that's very strong tends to not result in the economy accelerating. It burns rubber.
Right. The other approach, one-off handout, it might be up to $400 to those ending $126,000. So you're not a big fan of the fuel excise in terms of solving that and what the RBA will be looking for, but just handing out cash, that'd be even worse for inflation, presumably.
Yeah, look, none of it is a good idea. To be clear, what has changed is the economy. 2 years ago, almost exactly to the day, the Australian economy was on its knees. And support from the budget at that time was vital, and it worked spectacularly well. Most Australians would never have lived through a weaker economy than that moment a couple of years ago. Many Australians won't have lived through a stronger economy than right now. Now, I know, lots of people listening may not see it that way, but the strength is not showing up in wages, which is how, the bulk of people might have felt it. It's showing up in jobs. And that is spectacular. Unemployment basically heading to the lowest in half a century, and doing so pretty fast. And our job recovery better than any other leading economy around the world.
So this leads to the government saying wages are going to pick up. The two key questions: will they actually get ahead of inflation? And will this prediction be correct when so many others have been wrong?
Yeah, and so we do think wage growth will pick up from here. It is already picking up. It's just picking up from record lows. And with an unemployment rate as low, so Treasury is looking 3 3/4. We actually see 3.5%. With an unemployment rate that low, we do think wage growth will pick up. A frustrating thing about Australia is that our wage, any nation around the world, wage growth tends to move slowly. In Australia, it moves slower than the average. We have a system that's geared to 2 and 3 and 4 year agreements, or to big safety net agreements. So our wage growth tends to move slower than many others. It will pick up. We would say probably ahead of inflation over the next 12 months, but partly that's because even ignoring the fuel excise side of it, we think petrol prices are coming back down. Certainly that's what today's oil prices are suggesting.
It does make the RBA's role interesting because of wages as a lag factor and their focus on wages before they actually lift rates. It might be while the inflation sort of shot up. Anyway, take that as a quick comment. I wanted to ask you about debt, budget repair. Excuse me, a bit of dust in the studio, but the government says basically, and both major parties are saying this, we're not going to look at big cuts. We're going to grow the economy better than we have been, and that slowly fixes the budget. Is that really budget repair?
Look, it is, but it's slow budget repair, and that contains some risks. Part of the reason why Australia handled the COVID crisis better than most other nations is there was bipartisanship around using the budget to help the Reserve Bank. And remember, the Reserve Bank was basically out of ammo. Help the Reserve Bank fight off the economic effects of COVID. Worked really, really well. COVID, however, won't be the last crisis that Australia has to face. We can live with slow budget repair. We just need to recognise that we may well face another crisis, maybe even another big crisis, without a budget that's in great shape.
All right, it's a point made by many. So I guess with no one actually suggesting we do otherwise, we'll just have to see how it plays out. Chris Richardson, thanks for your time today.
Thanks, Tom.